A few months ago, some units of IL and FS defaulted on some of their obligations. This led to fears of contagion in the market. In other words, people who lent money in the market, they were afraid to lend, thinking that other NBFCs will also default. Because of this, there was a liquidity crunch for the NBFCs. They couldn't access money, they couldn't borrow money. They have primarily two channels to borrow money from: banks and mutual funds. There were large redemptions from mutual funds, and mutual funds suddenly had to sell their NBFC paper. They could not take on further exposure. Similarly, banks also did not have enough wherewithal to lend money to NBFCs. Because of this, there is a big blow to the NBFC business model, which primarily depends on borrowing money from the short-term market and then on lending it. The loans which they give, they are typically long-term loans, and there is a asset-liability mismatch. So now there are fears that this liquidity crunch could actually hamper the business model of NBFCs, and it could lead to a solvency crisis. So why should you care about this crisis? Well, there are 3 points. One, NBFCs have significantly improved their share of credit to the economy. They reach places where banks don't want to enter, or they don't have the ability to enter. For example, in used commercial vehicle loans. Secondly, the costs of NBFC borrowings are going to go up. Now, that can lead to a certain set of problems, because when the costs of borrowings go up, NBFCs might also have to cut back on their lending. For some sectors, such as commercial real estate, a continuous flow of credit is like oxygen. When you cut off the supply of oxygen, that means these players, commercial real estate players, for example, they could default. Now, if they default, that means that NBFCs will have non-performing loans, and they in turn could default on their own borrowings. So that is why there is this big concern about that this crisis should be contained. Thirdly, because of this, we could see the flow of credit to the economy come down. If the flow of credit to the economy comes down, then economic growth will be constrained. And note that currently our economy is flying on only one engine, which is consumption. So if credit growth is constrained, and if consumption also comes down, then economic growth will definitely come down. So what have the government and the Reserve Bank of India done to address this crisis? For one, the National Housing Bank increased its refinance limit from 24,000 crore to 30,000. RBI and the Securities and Exchange Board of India issued a joint statement to calm down the markets. RBI also introduced a couple of other measures. It eased the liquidity coverage ratio requirements for banks so that they could increase their lending to NBFCs. It also allowed banks to increase up to 15% of their capital funds to NBFCs which are not in the infrastructure space from 10% earlier. So the big question is, are these measures enough? Well, banking system liquidity is still in deficit. The true test for NBFCs will come over the next few weeks, when around rupees 1.5 lakh crore are coming up for redemption or rollover of this debt. The government on its part wants the RBI to implement two measures. One, they want the Reserve Bank to dilute norms for banks which are under the preventive corrective action framework, weak banks essentially, so that they can increase their lending to NBFCs. Secondly, the government wants RBI to open a special refinance window for NBFCs. The RBI has resisted both these moves because it thinks that this crisis is not big enough, and doing so might send wrong signals to the market. A third alternative, which has been suggested by bankers like Uday Kotak, is to increase the refinance limit of the National Housing Bank further. That might provide some relief to at least one section of NBFCs, which is housing finance companies. In a nutshell, the NBFC crisis will constrain the flow of credit to the economy and hobble economic growth. It will also impact the business model of NBFCs. But to call this India's own Lehman moment is an exaggeration.